today, the first lesson is actually related to just an overview of corporate financing, no? Just so you have an understanding of um, where we are, what are we going to do, or what are the key questions that we need to answer in MSP 223. Okay. So just a review, no, in terms of the decisions that are of course that's related to corporate finance that the firm must undergo. Okay. So what you handled or what you looked into, no, in MSPN 222 is called the investment decision. Okay. So when we talk about the investment decision of finance managers, we are talking about or we are considering or answering the questions, where do we want to spend the cash, of the firm? Okay. So if you're trying to if you have cash and you're trying to allocate where to use that cash, that process of allocation of cash towards different kinds of assets is the investment decision of the firm. No, the investment decision of finance managers. Okay? And that and you know that what is the objective of that investment decision? The objective of that investment decision is to maximize shareholder value. That's what you learned in MSP 222. And how do you really maximize shareholder value? You do that by maximizing the net present value of projects. Okay? And you invest, hindi lang, hindi lang maximize actually. No? What you need to do is to invest in projects with NPV greater than zero. And that's the essential rule. And that's the objective when you're looking at where to invest your cash. Okay? So looking at the financing decision, which is the coverage of this course, the key question of the firm right now is fine. I have a series of projects that are worth investing into. The next question is, where do you source that cash? Where will the cash come from? Okay? And where will it come from? What are the traditional sources of cash that you know? Of course, you can borrow it, right? That's one way, right? Second way is to put your own money. You put an investor's money. And therefore, the second traditional way to source that cash is through equity issuances. Okay, right? Now, when you try to source your cash, whether from debt and equity, you know that debt has a cost, right? What is the cost of debt? The cost of debt is the interest that you have to pay, right? I mean, you can source the cash from banks, but banks will not give it to you without any consideration, right? So therefore, banks will have to charge you something. And that amount that banks will charge you is interest. So in effect, that's the cost of debt, right? For you to get debt, you need to pay interest. Now, let's look at equity. Does equity have any cost? Okay. So for example, you are a shareholder, for example, kunyari ako, I participated in the IPO of Mondinisi, in the recent IPO. If I participated in that IPO, I gave cash to Mondinisi, right? So I am an equity holder of Mondinisi. Okay. My the money that I provided Mondinisi, is that free? Okay. Nominally, it looks free, right? Why is it nominally free or costless? Because Mondinisi is not naman requiring and is not promising that I'm going to be paid dividends, right? I'm not being promised that I will get my money back, right? So I'm not being promised dividends. So from the point of view of the Mondinisi, equity looks free, right? Because you don't need to pay for it. There's no promise of dividends. Okay? But actually, what is the cost of equity? Well, equity has an opportunity cost, right? I'm sure these are things that we discussed already in 222. Okay? From the point of view of the investor, of my point of view as the investor, I have a hurdle rate, right? I have a required rate of return out of my investment in Mondelez. What is the nature of that required rate of return? Ang nature ng required rate of return na yun is that is the return that I'm requiring from Mondelez so that it's more efficient for me to put my money in Mondelez rather than put it in some other investment. Okay? Under the risk and rewards of Mondelez, I would have earned X% in the same kind of investment. And therefore, my required rate of return for Mondelez should be X% also. Because my opportunity cost, I can put my money in that other company with the same risk and return as Mondelez, and I'll earn X%. So therefore, that's my opportunity cost. The fact that I am investing in Mondelez no, is the opportunity cost because I would have earned X% in something similar to Mondelez. No? So in reality, equity is not costless because there's an opportunity cost of equity capital. Okay. So given that we know that debt and equity both have costs, okay, what will be your objective then in making the financing decision? Of course, your objective is to minimize the cost of money, right? Which of the following ba is cheaper? That's what I use. Or what combination of the two will be the cheapest? No? Then that will be the combination that I use. And therefore, your objective is to minimize the cost of capital. So yun yung parallelism niya. Okay? Maximize NPV for investment decisions. Minimize cost of capital for financing decisions. The problem is, okay, mas makokontrol mo yung maximize NPV kaysa minimize cost of capital. Right? Maximize NPV, saan ba nanggaling ang projections ng cash flow sa'yo? Right? And when you want to commit to a certain project with a certain cash flow pattern, it's actually the company who will need to deliver those cash flows, who will work on those cash flows, right? So companies have more control over investment decisions than financing decisions. Why? The cost of capital, this interest will be from banks, right? So you're just a price taker in terms of interest. Pag ayaw ka nilang bigyan ng murang interest, wala kang choice but to get the higher interest. Okay? The opportunity cost comes from equity holders. Okay? So, kung mataas ang required rate of return nila, wala kang magagawa. No? So, while it's easy to say that the financing decision is to minimize cost of capital, a firm actually has very little control over it. That's why it's more of an art, because you have to influence debt and influence equity to lower their costs. Okay? And look at the ratio or the blending that would be most appropriate or will deliver you the best cost based on whatever is the surrounding environment currently. Okay? So in terms of patterns of corporate financing, these are all US data. Unfortunately, these kinds of data, wala sa Pilipinas yan. I mean, our data bank is not very robust. Mahirap, yung paggawa ng graph na yan, mahirap gawin yan sa Pilipinas. So this is a graph of sources of funds of US non-financial corporations expressed as a fraction of total. Meaning, saan nang gagaling ang funding nila? Okay? When they're trying to fund projects, where do they usually get those funding? Okay? So let's define each one. The first is internal funds. What's the meaning of internal funds? Internal funds simply means cash generated by the company. Okay? So, manggaling sa operating cash flows or investing cash flows. Okay? So internal cash generation. Next is net borrowing. Okay, what is the meaning of net borrowing? That is borrowing less repayments. Kaya nga siya net. Okay. So if net borrowing is negative, it means that there were more repayments than borrowing for that specific year. Okay. And then what's the meaning of net equity issues? Okay. Equity raised less dividends and buybacks or any payout to the shareholders. Okay? Kaya siya net equity issue. So if the net equity issue is negative for that year, okay, it means there were more dividends than equity issuance for that year. Let's look at the trend in the US from 94 to 2008. So if you look at this, trend, what can you see? Look at the green bar. Okay? Almost like 70 to 100% of the funding requirements of a company is usually funded by internal cash generation. Okay? And the second usual sources of funding is in yellow. That's number one. Number two, debt. Right? Positive siya. But if you look at number three, negative pa nga eh, ang equity issuance. So if you look at this trend, what does this mean? It means that in the US, most companies actually prefer to use internal cash rather than borrow from the outside or issue equity. Okay? In fact, between issuing equity or borrowing funds, they will more likely borrow than issue equity because most of the net equity issuance, most of net equity here is negative. Right? Meaning mas malaki yung dividends and share buybacks kaysa sa equity issuance. Okay? Kaya negative. No? So, looks like there's a trend in the US, right? But is this something that maximizes value? No? Are there any issues with respect to this? And are firms relying too much in internal funds? That's something that we need to investigate. What's the problem if a company relies more on internal financing? Well, the advantage of of relying more on internal financing is that internal financing is of course more convenient than external financing or stock and debt issues. Why is that the case? Because of course, pag external and debt and equity ka, maraming proseso yan bago ka makakuha ng pera, right? You will likely have to do due diligence, like regulatory requirements. There are transaction costs related to it. No? But some investors worry that managers have an irrational or self-serving aversion to external finance. Why? Why would they have a self-serving aversion to outside finance? Because if they do outside financing, management will be under scrutiny, right? If they issue a bond, yung mga banks will do due diligence of the company, right? If you issue equity, regulators will likely require documents that will expose some of the performance of the entity and therefore affect management appraisal. Okay? So therefore, they're a little bit concerned of showing their performance, which is normal. So they might be, but the problem with that is there is a disconnect between the goal of shareholders, which is to maximize value, more than the goal uh, of the of the managers. So that's a basic agency cost or agency issue. A manager seeking um, something that is very simple in his life could be tempted to forego a risky but NPV positive project if it involves issuing stock or issuing equity or issuing debt. Baka i-forgo na lang niya. Huwag na lang tayo mag-invest sa NPV positive project kasi hassle mag-issue ng equity, hassle mag-issue ng bond. So that's one kind of agency cost that or agency issues or conflict which beset management and shareholders. So those are some of the things that we need to understand. Okay. Next. So these are all again US data. If you look at the first table here, this is the sum aggregate balance sheet, okay, of manufacturing corporations in the US in 2008. So if you look at the aggregate of manufacturing corporations, total stockholders' equity is 2,775. Total debt, long-term debt, is 2,490. So at that point in time in 2008, that's roughly less than 50%. Say 40 to 50% of total capitalization in the US is debt. But if you look at it over time, what happened? The red is the book debt ratio. So book meaning it used book values for both debt and equity, right? What was the trend in the US from 1955 rather, to 2007? It started at 30%, it ended at 40%. So if you look at the trend over time in the US, okay, debt ratios have actually increased over time, you know, for manufacturing corporations. Okay. So is there a particular reason why this is happening? Okay. And does that mean that the optimal capital structure should be around 30 to 40%, or currently 40%? If other firms are at 40%, probably that's the market equilibrium, you know, where we should all settle at 40%. But it's not a proper um, output or outcome. Yeah, that's something that we need to understand. It's not necessarily the case, yung sinabi ko, because if you look at market debt ratio, meaning use market values of debt and equity, if you look at the trends, it actually peaked at 50% during 1971 to 1991, but it went down so fast from 1991 to 1999, and then went back up again. Yet the trend is actually flat, right? I mean, it is, okay. If you get the trend, this is actually a flat trend, more or less, right? At 35%. If you look at market values. So book debt ratio is increasing, but market debt ratio is flat, which makes the conclusions a little bit more murky, right? So ano ba talaga? What's the trend? Okay. In this case, does debt ratios or debt policy or capital structure policy actually matter? If it's not, if it's not, I mean, if it's not consistently increasing or decreasing over time, and market debt ratio and book debt ratio gives conflicting results. Okay. And if you look at the US, in terms of the debt, liabilities to total liabilities plus equity for manufacturing firms in 2006, it's not actually, parang, these are all developed countries. In developed countries, that ratio is high. So does that mean that the trend from developing to developed countries is also like that? And if so, why is that the case? No? So those are major questions with respect to capital structure policy. Now, when we talk about capital structure, we're talking about the mix of debt and equity. So let's review and recalibrate what we know about debt. Okay. Debt is a contract, promise. So it's a promise, may R. It's a promise by the borrower to repay an amount owed to the lender on a certain future date and pay a specified sum and for interest per period until that date. In other words, it's a promise to pay someone back, at a certain future date, to pay a specified amount at a certain interest. What are the key features of debt? Number one that we will always say in this class is debt has a fixed claim. When we talk about fixed claim, it means that there are two things that are being fixed. Number one, the terms are fixed by a contract. Okay? It may fluctuate, but the term of how that fluctuates, or the how that fluctuates are all fixed in a contract. So essentially, that is a contract, and it is all fixed in that contract. By fixed meaning itinalaga. I'm not saying that it's constant, right? But it was written in the contract on what terms will this debt be. Okay? Another way to interpret fixed claim is that the amount paid to the lender does not depend on the performance of the firm. It's fixed by what the contract says is the amount of the claim. Okay? Why is this important? Because as you know, equity is a residual claim rather than a fixed claim. If it's a residual claim, it means that anything in excess, I mean, any wealth or value of the firm, in excess of debt goes to the equity shareholders, the equity holders. So therefore, they have residual claim rather than fixed claim. Okay. A second important aspect is that it is a priority claim. When it's a priority claim, when a company defaults, means their lenders have a priority or senior claim over those assets. Okay, you know this already from 219. Okay. Of course, that may include covenants. What are covenants? These are conditions or requirements that are required by lenders. Okay. Again, they may require collateral. The collateral are attached assets that the lenders may claim in the event of default or non-payment. Okay. And also, when we talk about default, it means that the usual interpretation of default is that hindi nakabayad was non-payment of interest. But there could also be other ways of default or other reasons for default. If hindi nakapag-comply sa covenant, that would be an event of default. If the company defaulted on some other debt and not the specific debt of this bank, that could still be an event of default for this bank. So hopefully we'll discuss those items when we go to the issuance of debt portion of our class. This is just a review, you know this already. Second is equity. As you know, equity refers to receivable claims. Okay, you know that already. But the other feature of equity that is equally important, aside from having receivable claims, is the concept of corporate control. Okay? A very important aspect of equity is that equity holders control the business. Okay? And therefore, they have the ability to influence the future of the company, the future value of the company based on the strategies and decisions and uh, and other approved items of the shareholders. Okay? So that's another aspect of equity that is equally important as is in your claims, is the ability to control corporations. Okay? Shareholders elect the board, which in turn selects and appoints top management, sets strategy, evaluates, rewards management, and approves substantial transactions. Of course, there are some items where the shareholders will directly participate or directly approve decisions like mergers or other large transactions. As you also know, there are two forms of equity, common and preferred. Let's start with preferred. Preferred shares have a higher claim to dividends than common stockholders. And usually, preferred shares have details on whether details on how the preferred shares are going to be treated annually in terms of dividends and liquidations. Usually there's a dividend rate. The voting rights are likewise spelled out, whether preferred shares are voting or non-voting, liquidation value, etc. Common shares are always voting. Preferred shares can be voting or non-voting. Common shares, as you know, is the stock that represents the residual ownership in the corporation. They are paid with dividends or upon liquidation, they are paid after creditors, bondholders, and preferred stockholders. That's why they're called the residual owners of the firm. Okay. So when we talk about financial leverage, leverage simply means the amount of fixed financial cost in the firm's income stream. So when we talk about fixed financial cost, that's usually in the form of interest, right? Financial leverage can therefore be defined as the potential use of fixed financial cost to magnify the effects in EBIT and EPS. We will discuss that in the next slide further. In reality, there are two financial costs that, that, that results in leverage. Interest on debt and preferred stock dividends. Kasi preferred stock dividends are also fixed costs, right? Similar to interest. But usually, when we talk about leverage, we are only dealing with interest on debt. And we're just talking about debt in general. Okay? And that's what we do from here on onwards. So let's look at this example. What's the effect of financial leverage? Let's go one by one. The company expects EBIT of 10,000 is the expected EBIT. Okay? And it has the following. It has a $20,000 bond with a 10% coupon rate. Okay? And an issue of 600 shares of $4 annual dividend preferred shares. And it has also 1,000 shares outstanding. Okay? So if you look at this information, the EBIT is the EBIT is 10,000, right? And for you to get from EBIT to earnings available to common shareholders, meron yung mga items in between, right? Okay. The question is, what is the current EPS and what happens to EPS if EBIT is higher or lower by 40%? So in case 1, higher by 40, case 2, lower by 40. Let's discuss what is EPS. EPS is what? Earnings available to common stockholders divided by technically weighted average number of shares outstanding, right? Or simplified, number of common shares outstanding. Okay, that's the simplified version of EPS. Okay, so here, how do you get to the numerator? Okay, so from EBIT, you need to less interest, then you get to EBT minus taxes, then you get to net income minus preferred dividends, then you get to earnings available to common, and that's what we will do. Okay, how much is interest? So that computation pwede na natin gawin for all. The annual interest is 2,000, which is 20,000, which is the bond, times 10%, which is the coupon rate. Okay, so every year the interest is 20,000. So that's why here, under our base case, the interest there is 2,000. And therefore, you get to EBT or net earnings before tax or net profits before taxes, 8,000. You get taxes, assuming that the tax is 40%, taxes is 8,000 times 40%, and that's this amount. Okay. Then you get to net income. How much is preferred dividends? It's $4 for 600 shares, right? So the amount of preferred dividends is 2,400, and that's this amount. And from there, you get earnings available to common to 2,400, and then you're told that there are 100 common shares outstanding, 1,000 common shares outstanding, and you get the EPS of $2.40. Okay? Kuha ba? With that base case, we can compute for the other cases, right? How do we do that? Then we just change the EBIT to 14,000, which is 40% higher. Interest will stay the same. Hindi naman nagbago yung debt, right? So you arrive at EBT of 12,000. Hindi naman nagbago yung tax rate, 40%. So this is 12,000 times 40%. You get 4,800. And then preferred dividends, di rin naman nagbago. So you get earnings available to common of 4,800 divided by 1,000 shares. Case 1 EPS, earnings per share, is $4.80. If you go negative naman, negative 40%, the EBIT is 6,000. You you do the same calculation, you arrive at earnings available to common of 0, then the EPS here is 0. What can we surmise here? Okay. What's the key conclusion? It shows the impact of leverage. Okay. Why does it show the impact of leverage? If you see, the EBIT increased by 40%, but the EPS increased by 100%. It doubled from 2.4 to 4.8. It's not proportional. The increase is not proportional to increase in EBIT. Okay? So leverage magnifies better results, right? Because a 40% increase in EBIT results in a 100% increase in earnings per share. Okay? If you do the opposite, on the other hand, okay, an earnings decrease, EBIT decrease of 40% will result to a reduction of EPS by 100%. It's the zero out siya. Okay? It also magnifies the risk of down. It also magnifies the risk, okay, of bad performance, or risk and the impact of bad performance. And that's the impact of leverage in the financial statements, right? So when we talk about capital structure, we discussed this already. Capital structure is complex because of its interrelationship with other financial variables. Okay? Poor capital structure decisions can result in high cost of capital, thereby lowering the project LTVs and making them more unacceptable. Okay? And that's what we discussed in the beginning. The capital structure policy is important because having the lowest capital structure enables us to accept more projects actually, right? And will increase the projects of current project, increase the NPV of projects that are already viable. Effective decisions can lower the cost of capital, resulting in higher NPV and increasing the value of the firm. Okay. However, the question is, okay, is this always true? And that's what we seek to find out in MSP 223. Okay. So, exploring the relationship between EBIT and EPS, looking at the relationship, it shows that the capital structure can lead to a maximized EPS over the expected range of EBIT. Okay, there is an optimal capital structure because if you can optimize the EPS, then that optimized EPS, whatever the capital structure is also the best capital structure. Okay? A major shortcoming of the analysis is that, of course, earnings are not equal to value. Earnings are only determinants of shareholder wealth maximization. And so therefore, hindi siya very robust. It has very, probably it has practical consideration, but it does not have theoretical backing. Okay? Let's have this example. Okay. So a company is considering two capital structures. Situation 1 and situation 2. The expected EBIT is 50,000. The tax rate is 40%. So situation 1, ito yung capital structure mix. Okay? Meron siyang 500,000 debt at 8% and 10,000 shares. However, he's considering a lower debt capital structure. 350,000 at 7%, 20,000 shares. Okay? So if you look at the EPS for situation 1, EBIT is 50. You can compute the interest expense. That's 500,000 times 8%. Okay? You can get the earnings before tax. Tax expense is 40% of 10,000. Okay. Then you get 6,000 as the net income per share. 6,000 divided by 10,000, that's 0.6 per share. And if you do some sensitivity analysis, increasing the EBIT to 60,000 and decreasing it to 40,000, the EPS becomes 1.2 per share. If if EBIT is 60,000, then it becomes 0 when EBIT is 40,000. Okay. You can check the calculations at home. Okay. If you look at situation 2, on the other hand, under the base case of 50,000, the EBIT is, the EPS results to 0.765 per share. So if you look at 50,000 US dollars, the scenario, under situation 1, the EPS was 0.6 per share. Under situation 2, it is 0.765 per share. Therefore, can we conclude that situation 2 is better? Okay. No. Why can't we conclude that situation 2 is better? Because this relationship only is valid, no, at the 50,000 earnings before interest and taxes. Okay? Kasi if we draw it in a graph, ganito yung itsura niya. Okay? The green line is situation 1. The yellow line is situation 2. Okay? At 40,000, 0 ang EPS. Okay? At 50,000, 0.6. At 60,000, 1.2. Okay? Dun sa kabilang graph, sa kabilang slide, oops. Sa kabilang situation, I also try to graph it, no? By determining ano ba yung EBIT na 0 yung EPS, what is the EPS at EBIT 50,000, what is the EPS at EBIT 60,000. Okay? So, diyan ko nakuha yung graph na yon. 2450, 50,000, 0.765, 60,000, 1.065. Ito naman sa kabila, the coordinates of the graph was 40,000, 0, 50.6, 60, 1.2. If you graph the two, it shows that the optimal capital structure actually depends on EBIT. Why? Okay. So let's take note of this. Let's take note of this point. Okay. If the EBIT is between 0 up to this number, okay, actually, situation 2 is better than situation 1. Right? Mas mataas yung yellow line kaysa green line and therefore creates more EBIT. Okay? But if the EBIT is greater than this amount, greater than this point, yung may star dyan, okay? Greater than this point, we can see that the green line is higher than the yellow line, which means the EPS for situation 1 is higher than situation 2 for EBIT higher than this amount. Okay? And therefore, this shows the financial impact of leverage. Okay? It magnifies the impact of the variability in EPS. Okay? Pag mas marami yung deviation versus this amount, okay? Mas mataas ang increase sa situation 2 kaysa situation 1 kaysa situation 2. Okay? At kung mas mababa naman than this amount ang EPS, mas malaki yung decrease in EPS for situation 1 than situation 2. And situation 1 is the one with the higher debt, right? If you remember, situation 1 has $50,000 debt, $500,000 debt. Situation 2 has $350,000 debt. Okay? And the graph clearly shows that mas magnified yung impact between EBIT and EPS for situation 1. In fact, the slope of situation 1 is higher than the slope of situation 2, which shows that it has a higher rise over run depending on the EBIT that you will have. Okay? So therefore, it's really difficult to have an optimal capital structure, right? Because it depends on the EBIT, which makes it more of an art. How confident are you in your EBIT? Okay? If you're confident on the EBIT, then probably, and the EBIT is really 50,000, then situation 2 is better. But there are risks to consider. There are opportunities to consider. So those are some of the finer points of capital structure. So here, this point, which is the indifference point, what is the level of the indifference point? It's the point where the EPS for situation 1 is equal to the EPS in situation 2. Right? How do you compute the EPS in situation 1? Ito yun. EBIT minus interest. Okay? And then you make it after tax. Then you makarating ka na sa net income. Right? Divided by 10,000 shares outstanding equals EBIT. EBIT here is the variable. Then interest. Then after tax. Divided by 230,000. Okay? You can solve for EBIT here. And you will get the indifference point. Okay? At that point, okay, then you are indifferent between situation 1 and situation 2 because they have the same EPS. Okay? So, compute that at home. What is that indifference point? Algebra lang yan ito. Okay? So, I won't give you the answer para may gawin ka naman sa bahay. Okay? But you have sort of an idea where it is. It's between 50,000 to 60,000 according to my graph. That is not to scale. Okay? Pero medyo to scale. Medyo around that number. Kung nasaan yung line, yung orange line na yun. Okay, so determine what is the EBIT for the indifference point. And number 2, determine the EPS. So somewhere here, between 1 and 0.2. Okay. Now, the problem with this analysis is that it's simplistic. Why is it simplistic? There are so many questions that we need to answer. Okay. And we will know more in MS 2023. Okay. Number 1, it assumes that maximizing EPS is the most beneficial for shareholders. But Corporate Finance 1 taught you that value maximization is the ultimate measure of stockholder decisions. Maximizing EPS is not equal to maximizing value. So that's why the previous analysis that's very elementary will not cut it in terms of deciding in the capital structure. It's not enough. It might contribute to your decision making, but it's not enough. Okay. Second, if you notice, the interest rate for situation 1 and situation 2 then, the interest rate decreased for situation 1 versus situation 2. Okay. That is one major assumption of this analysis, right? That it's 8% if in situation 1 higher debt, It's 7% if it's situation 2, lower debt. Okay? That's a major assumption of this analysis. But what we need to understand, you know, is this correct? Interest rate decreasing from situation 1 to situation 2. And if it is correct, why is this the case? When the business is practically the same. Okay? The cash flows from the business should be the same. Why is there a difference in the cost of debt? Okay? What influences that decision? Third, does the decision to alter capital structure affect stock prices? Okay. Here, we're not considering the market. It's only accounting in the previous analysis. EBIT-EPS, those are accounting measures. But does the decision of capital structure also affect stock prices? Yes or no? Dividends effectively change the capital structure by reducing equity of the firm. Diba? When you declare dividends, nabawasan yung retained earnings, and so therefore total stockholders' equity decreases, and therefore, from a relative point of view, the capital structure changed. There are no more debt when you declare dividends. Will it create the same impact as increasing debt? And lastly, from a capital structure decision point of view or a capital budgeting decision point of view, does investment in financing do that? Does investment in financing affect or does not affect? Essentially, those are the themes that we will answer in MS 2023. All right? And I think that's the last slide for the lecture. Okay. Any questions on the lecture so far? So it's just an overview of where we are. And hopefully this is able to give you a little bit of a roadmap of what to expect in MS 2023. Any questions?
Sir, just a minor question from me. For purposes of our class, how relevant is finance costs that arises from these liabilities?
What do you mean how relevant?
Do
I mean, what do you
we
mean by that?
minus it also from EBIT in computation of your EPS?
Yes,
Okay.
because, well, wala dito sa slide yung formula ng EPS. But essentially, EPS is earnings available to common stockholders divided by weighted average number of shares outstanding, right? But what is the numerator? Earnings available for common shareholders. It means all other sources of capital have already deducted their share. Okay, so this will be EBIT minus interest. When we deduct interest, it means that we have already that the share of the debt of the lenders have already been excluded out of income, right? No, minus taxes because this is the share of the government, and minus preferred dividends. This is the share of the preferred dividend preferred stockholders divided by weighted average number of shares. So for you to arrive at earnings after earnings available for common stockholders, you need to deduct interest from EBIT. Kasi EBIT is earnings before interest and taxes. So interest and taxes have not been deducted from EBIT.
Understood, sir. Thank you.
Any other questions? Clarification? Okay. Actually, this lesson is the undergraduate summary of capital structure policy. If you read undergraduate books for capital structure, it will only discuss EBIT and EPS. Okay? Kasi pang graduate program yung theoretical foundations, value, etc. So this is actually the whole undergrad portion of capital structure policy. Okay? But what I am trying to demonstrate is that what there's so much more questions to answer. Okay? Now that you know more about finance. Okay? And so we do not accept plainly that this analysis is enough. for capital structure decision making. Probably it has an input. You know. I mean, if I am, for example, a listed company, I'm a CFO of a listed company. I know that at the end of the day, stock price is more important, right? But I also know the whims of the market. I know that that eh, accounting income influences the market also, right? So I might also care about EBIT and EPS analysis, right? Kasi pag na-demonstrate ko sa EPS that there's value in the capital structure decision, then baka mag-react ang market positively. Therefore, affects my stock price positively. So I'm not saying that this is not enough, this is not correct, but what I'm saying is this analysis is not enough. There are so many other things to consider in capital structure decision making. Okay? Other questions? Going once, going twice? Sakto, 7:31. That's my target na 1.5 hours yung buong PowerPoint na to. Alright, alright, alright. No other questions? Okay. So we're done with the lecture part. So before I'll stop the recording.